Hello everyone and welcome to this presentation on the CFA Level 1 exam for December 2014. In this presentation, we look at reading 31, Income Taxes. We have received many requests to make a video on this topic. Many candidates find this reading very challenging, but once you get the gist of it, it's actually not that bad. We'll make several videos on this reading, and we will talk about the differences between pre-tax income and taxable income. We'll discuss deferred tax assets and deferred tax liabilities. We will explain how deferred tax assets and deferred tax liabilities are created and how they're affected by changes in tax rates. We will learn how to calculate the tax base of assets and liabilities. We'll distinguish between temporary and permanent differences in pre-tax income and taxable income. And finally, we will explain the valuation allowance account. In this video, we'll focus on the first two bullets, and in subsequent videos, we will look at the remaining bullets. Now, before we get into this presentation, there's one thing to remember, is that if the information reported on financial statements was exactly the same as the information reported on a company's tax return, there will be no need for this reading. The only reason we need to go over this reading is that companies report different information on their financial statements compared to what they report on their tax return. These differences can arise because of many different reasons. Companies always have the financial incentive to defer taxes. They want to minimize the amount of income reported on their tax return, whereas they want to maximize the amount of income reported on their financial statements. This is one reason why there can be a difference between information reported on financial statements and tax returns. The other reason is that the accounting rules and tax rules may be inconsistent. For example, under accounting rules, a company might be required to expense all of its research and development expenses in the year in which they were incurred, whereas under tax rules, a company might only be allowed to write off 20% of its R&D expenses in any given year. Regardless of the reasons, the important thing to note is that the information reported on financial statements is often different from the information reported on a company's tax return. Now let's look at an example. An asset is acquired for $120,000. It is depreciated using the straight line method for financial reporting purposes and an accelerated depreciation method for tax reporting purposes. The useful life of this asset is 3 years and there is no salvage value. Now right away we can tell that a company might be using the straight line method for financial reporting purposes and an accelerated depreciation method for tax reporting purposes to minimize the amount of income reported on its tax return, whereas reporting a higher income on its financial statements. Let's look at how this works in practice. Let's start with year 1. We will assume that the sales revenue over the life of the asset remains the same at $200,000. However, the depreciation expense will vary between the financial reporting and the tax reporting. Under financial reporting, the amount of annual depreciation expense is simply the initial amount of the asset divided by its useful life, which is $40,000. And for tax reporting, we're assuming that the company is reporting $60,000 of depreciation expense in the first year. Notice that the amount of income reported on the income statement is higher than the amount of income reported for tax purposes. Therefore, the amount of tax reported on the income statement is also higher than the amount of tax on the company's tax return. This simple example actually introduces some key terms. The amount of income reported on the income statement is known as pre-tax income or earnings before tax or accounting profit. This is different from the amount of income reported on the company's tax return, which is known as taxable income. The amount of tax reported on the income statement is known as tax expense, which is different from what is actually owed to the government, the actual amount of tax owed to the tax authority, which is known as tax payable. Finally, the carrying value or the book value of the asset is simply the initial value of the asset minus the amount of depreciation. And similarly, we have the tax base of the asset for tax purposes. Notice that the amount of tax reported on the income statement is $8,000 higher than the amount of tax reported on the tax return. What happens to this $8,000? Has the company eliminated this tax? Let's see. In year 2, the amount of sales revenue remains the same. The depreciation expense continues to be $40,000 for the income statement. And we have only $40,000 of depreciation for tax purposes. This is lower than first year depreciation of $60,000 because we're using an accelerated depreciation method. The income and the amount of tax reported in year 2 are the same for financial reporting and for tax reporting purposes. In year 3, the sales revenue remains the same, but the depreciation expense on the income statement is actually higher than the depreciation expense reported on the tax return. This results in a lower income being reported on the income statement and a lower amount of taxes being reported on the income statement compared to the company's tax return. Notice that the difference between tax reporting and financial reporting is exactly $8,000, which is the same as the amount of tax difference in year 1. What does this tell us? The total amount of taxes paid over the 3 years was the same, $192,000. However, under tax reporting, the company paid $8,000 less in tax in year 1, and in year 3 it paid $8,000 in taxes more compared to the income statement. Therefore, the $8,000 in taxes were not eliminated, but the company benefited from deferring this tax amount. Given the time value of money, companies would rather pay this tax in year 3 rather than year 1, especially because the government did not charge any interest on this $8,000 in tax. The deferred tax is a liability because even though the company did not pay this amount in year 1, it expected to pay it in year 3. Now in our example, the amount of taxes reported in the tax return was lower in the first year than what was being reported on the financial statements. However, the opposite can also happen. If the taxes reported on the tax return were higher than the amount reported in the income statement in the earlier years, that would have resulted in a deferred tax asset. This is because the company would have essentially prepaid a portion of its taxes, and in the future, the company would expect to pay lower taxes. Now, this was a brief discussion of deferred tax assets and deferred tax liabilities. We'll look at this topic in more details in the next video. Now, this brings us to an end to this presentation. We hope you found it useful. Please let us know if you would want us to make a free video on a topic of your choice. If you found the video useful, please make sure to subscribe and to like it. Thanks very much for watching, and I wish you the best of luck. Thank you.